Welcome to PowerCharting. My name is Bruce Fraser, and we are on episode number 13, which was recorded on October 25th of 2018 and will be first aired on October 26th of 2018. And I am here with my co-host, Roman Bogomazov. Roman, welcome.
Thank you, Bruce. As always, happy to be here.
So we are having a discussion on the current market, distribution or accumulation. So this is a heady topic. So let's jump right in. First of all, we would encourage you to join us on the Wyckoff market discussions, which we hold every Wednesday at 3 p.m. Pacific time. And this is a current analysis of the markets. And we spend an epic hour and a half to 2 hours going into tremendous detail on markets, commodities, stocks, you name it. And so this is a great show. We love doing it. We encourage you to look at my blog, which is at StockCharts.com. And it's the Wyckoff PowerCharting blog. And Roman, tell us a little bit about Wyckoff Education.
Yeah, as Bruce has mentioned, his blog, and it's a free source, and there is so much content on Bruce's blogs there. So I always recommend our students to go and read this. But you also could go to our YouTube channel, and it's also a free resource. There are some free articles on wyckoffanalytics.com. And if you have any questions about any of the offerings that we have, either from wyckoffanalytics.com or from Bruce and I, or from Bruce, just contact us at wyckoff@gmail.com. We'll be happy to answer you.
So they would go to wyckoffanalytics.com to find out more about your classes and about Wyckoff market discussion and so on.
Yes.
And how to sign up.
Yes, absolutely.
Terrific.
Or just email us.
Terrific. All right. Well, let's get to work. We don't have much time.
That's true.
What are we looking at?
Well, this is a part of the presentation that I gave yesterday at Market Watches Live. This is also a part of the discussion that Bruce and I have had 2 weeks in a row about the markets. And usually when the markets are so volatile, we want to look at the health of the market and therefore use some kind of market breadth indicators or market sentiment indicators. We're looking here at the New York percent of stocks above 200 moving average. And you could get this data from StockCharts. And one of the things that usually is being talked about on this indicator is the low readings that this indicator provides us with, and that usually coincides with the significant cyclical or secular lows. And we see that from the low in 2003, which was, a big secular cyclical low, a secular low in 2008, 2009, and then a couple of cyclical lows, rotational lows within the context of the uptrend. So what happens after that, when the stocks are so depressed either in the rotation or in the cyclical low, as there is some buying by institutional hands, that produces a lot of the new highs in the stocks out of the depressed position that they have. And therefore, we have the first big momentum to the upside that identifies the first leg of the uptrend. So this could be by itself an indication to us that there is a lot of buying going on, and a lot of stocks are reaching those new highs. Then please note that during the uptrend, the number of stocks above 200 day moving average is not necessarily going to be above the previous highs. And this is a typical trending environment. In this environment, a lot of the analysts are going to be saying that we are having some kind of divergences where we're seeing a divergence between the number of stocks going higher and actually going lower. And then the price is still going higher. So that's going to be a misconception about the trending environment. And then after that, a sharp break could come in this indicator on the percent of stocks above 200 moving average. And a lot of the stocks will travel down, will go down. And with that, we're going to have this big break. And usually that's going to be associated with structural positions where we're going to have a change of character for a potential distribution or rotational reaccumulation. And then after that, when the market deteriorates and the price structure starts to show lower highs, lower lows, this is where the index is going to, the indicator is going to show us that we are in the some kind of bearish environment. And therefore, the price is going to follow that. Bruce, what else could you add to this?
Well, this is one of my favorite indicators, and it's a form of a breadth indicator. And the way that I've used this, just very simply, is in the past is when you're in the uptrend, which is these sort of tan box areas. When you're in an uptrend and you see this indicator retreat down to around the under 50, like 50, 45, 40 area, this is an area where you're looking for an important low in an uptrend. And this is a great opportunity for trend followers to add on or enter new positions in a vibrant uptrend. So this is a very, very useful in that regard. The other thing is, notice the price destruction that occurred in January, February of 2018, which is this most recent yellow box area. Notice the decline that occurred. This was evidence of a change of character in the market. And the way to describe this is looking at the number of stocks that are above their 200-day moving average is a definition of an uptrend for a stock. And notice how there was a big break in the number of stocks above their 200-day, which is a destruction of positive market breadth. And then the rally that occurred in 2018, after that, you can see that the rally in the indicator and the rally in the market both had poor breadth qualities to the rally. And you can really see it in the indicator. So this puts us on the alert. And we have much fewer stocks above their 200-day able to support a vibrant uptrend. And now we're seeing some important price destruction in the market. And Ramon, where is the indicator now?
Well, the biggest question for us is looking at the yesterday's reading, which is 25.79%. So this is below 40. This is below 30. So we are in that bear market type of indication. So I think the biggest question, Bruce, for us is, in the current structure that we have here, are we in the environment that indicates either a potential distribution or potential rotational reaccumulation? So I would suggest us, to look maybe at some analogs and some structures.
Wow. Well, this is a really important question. So you have my full attention. Let's keep going.
All right. Well, let's look at some of the analogs. So this is the 2018 structure that we currently have. And by the way, this is a little bit outdated. So we had one bar to the downside, and today we're trying to go up. So please bear this in mind. This is the slide from that presentation. But look at the analogs. For instance, S&P 2000 top had also a climactic run into the buying climax, had a change of character that had this urgency to sell by institutions. Then it had some kind of reaccumulation qualities within the larger, bigger structure that produced a rally. We see it here as well. And then an upthrust. In this case, in 2000 top, we're seeing an attempt to upthrust. And then after that, the price went down into the middle of the range, tried to recover on a very weak rally unable to do so, and then went back to the support area. And I think that analog-wise, we're kind of at this spot in the middle of the range. So we still, if we're thinking about the distribution, there is a possibility that the price could go lower. Another analog is ORCL from 2000, and ORCL was one of those big stocks, leadership stocks of that era into the 90s uptrend, like Microsoft, like Dell, like Sun Microsystems. So the leadership is being distributed in a different way than the laggards. And we're seeing this analog as a great example for us to compare with the current market structure, just because the US markets are so strong. So we see the same characteristics: climactic run, change of character, elements of reaccumulation, a rally, upthrust, and now we are in the middle of this range and continuation to the downside. It's the same with the S&P 2007 top, climactic run, change of character, reaccumulation pattern, then a move to the upside into the upthrust situation, and then we are in the middle of the range somewhere here, which suggests again a continuation to the support. Bruce?
These are classic Wyckoffian distribution structures, and we're actually going to look at those in a minute. The thing that's so important and interesting about understanding how distribution forms, because we can see it in so many different ways. These charts have unique characteristics, each one of them, but they also have common characteristics because there are large interests that are selling large amounts of stock as these distribution structures are completing, and the upthrust is that concluding terminal advance, which leads to tremendous weakness. And we're having this weakness right now, as you can see from the SPX 2018 chart. And this is a common response from the indexes to this activity. And so it behooves us to become really knowledgeable about how and why distribution forms. And because the character of the market is dramatically changing all of a sudden. It just seems to come out of the blue. But it's not coming out of the blue. There were advanced warnings of distributional characteristics. And you can see from the prior indicator that we looked at that there was deterioration underneath the market in these breadth indicators that suggested that there was distribution or selling taking place below the surface that can't be seen so easily in the indexes. Okay, having said that, Roman, where do we go from here?
Well, let's look at the current structure in more details, and let's talk about different scenarios, because we don't want to be thinking about one scenario. We always want to be thinking that the market could present to us both of the scenarios, and we just want to follow the market. And here we have two schematics. These are the schematics that we've created for the understanding and the visualization of the distribution of leadership assets. And again, I'm stressing this out, US relative to all of the other world markets is a leadership market. And usually the tendency here in the distribution of leadership assets is going to be that we're going to have a lot of elements that are going to be similar to a reaccumulation. And we actually could trade those, like we've been calling swing trades to the upside since April, May of 2018, and those worked out really nicely. What we need to be aware of are two things. The initial change of character that shows some distributional pattern where we see that there is some selling by institutions, and then the next move to the downside, inability of the price to go higher. And usually that would conclude with the upthrust. One more thought here I'm going to give you, and then Bruce could walk us through the charts here, the actual charts, not schematics, is that in the distribution of the leadership assets, we are going to be still under the visualization of an uptrend. We're going to see the higher highs, higher lows, and that usually is going to be interpreted as a continuation of an uptrend. And that's why it's so tricky to see the distribution in the leadership assets. Bruce, could you walk us through these two charts, and what do you see here?
So the broad price destruction that occurred in January, February, the market participants seem to forget as an uptrend reformed in these indexes. But we could see from that market breadth study that there was destruction of price in the vast number of stocks by the number of stocks that were now trading below their 200-day moving average, which is a simple definition of a downtrend. And so here we can see a long, laborious attempt to go up, 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 up. And we had good point and figure counts that you can go back, look in my blogs. I published them, some of them. And you can see that there was really nice point and figure counts that pointed to rallies which were fulfilled at the upthrust. But here's the thing. A buying climax in Wyckoff definition is a period where the large interests show up and start to sell their stock in earnest. And in fact, they're selling stock in that last leg up into the buying climax. And then when the market breaks, there's a huge change of character in the way the market trades in that decline. So now we have to be on the alert that the buying climax is an area where professional interests with large amounts of stock are going to be looking to sell more stock. So they sell on a scale up into the upthrust. But when the upthrust occurs, this is a very vulnerable place for the market because it's at the buying climax peak where a character of trading changed before, and we saw from those prior analogs that that's exactly what happens. You can see that in our schematic. These schematics were drawn years ago. And in fact, there's great distribution schematics, the Wyckoffian schematics that go back, many decades. And so our job is to understand the sequence of events as we go from the beginning of distribution to the end. So this is a big looming question for us. Is distribution complete in the market? We have an upthrust that occurred in the S&P. We have an upthrust that occurred in the NASDAQ composite. In both cases, there were attempts to test the upthrust, which failed, and then the market responded by going down almost with the same vigor that it went down after the buying climax in January. And so now we're in a situation where we're clearly in a range-bound market. The uptrend was negated at the upthrust. And so now we're in a situation where we have to ask the question, is this a reaccumulation that's going to take time to develop into another uptrend, or is distribution now nearly complete? And are we soon to be in a markdown? Ramon?
Well, let's answer exactly this question. So how would we do this? We probably would look at the causality that was created by the most recent distributional patterns, and we just want to measure this. So Bruce, on the next slide, we have your P&F count. And before you go through this, I just want the viewers to look at the right of this slide and look at all of those symbols that we have here. What is this? Well, actually, a lot of the slides were recycling from Market Watch's live presentation and from Wyckoff Market discussion class. And this is exactly what we have in the WMD class. We are showing our students all of the charts that we're going to go through for the session, and that's how it looks. So we're discussing these two charts. Bruce, P&F, what's the causality for this most recent down move? Have we fulfilled our objectives?
By the way, Market Watchers Live, Ramon was on yesterday as the guest on that program, and now you can see that on YouTube. That was a wonderful presentation. He goes through these international markets, and compares them to the U.S. market, which the U.S. markets and the U.S. indexes have been much stronger. And so just a fantastic presentation.
Thank you, Bruce.
Go to the StockCharts YouTube channel and stream that and watch Ramon's presentation. So having said that, what we did was we just looked at the area of the upthrust. So we're not even going back and looking at point and figure back to the January, February change of character decline after the buying climax. So we're just isolating this one area. And in fact, when you look at the S&P, we're using 60-minute data. And so we're using intraday data to assemble our point and figure chart. And this goes, actually the 60-minute data goes all the way back to March. And so, and we're just isolating this last push up, which has the attributes of distribution in it. And so distribution can show up, can occur in smaller time frames, which is really, I think, useful and important to intraday swing traders, to short-term. They work on virtually all time frames. So very short-term traders can use these, swing traders can use them, and you can see this 60-minute chart is ideal for a swing trader that's trading for moves that last from weeks to months. And so now what you can see here is that we have one box reversal. We're using 20-point S&P box size. So the scale over here is 20 points each increment. And we're counting across 20 columns. So from the last point of supply is what we would say to preliminary supply. So it's 20 times one box reversal times 20-point scaling gives us a S&P 400-point projection, and we take two levels here. We take from the high, and we take from the count, what we call the count line, which is the LPSY over here. And so we do an entire series on how to do point and figure counting, which is available on the website. So definitely go there and have a look at that. We just did this wonderful 3-part series on the nuances of point and figure counting. So anyway, here you can see that there was that first break off the upthrust, and then an attempt to decline and pause, and this occurred in the month of October, and now it's attempting to commit back down towards the objectives. Now this is a little out of scale here, but you can see the objective is 2540, 2380. And so you can see that there's a further for the S&P to go before it fulfills these initial point and figure counts. And so there may be lower prices. And in fact, this does take us down to the level of the lows of the giant trading range that we've been in all of 2018 so far. So this makes sense. It makes sense that this distribution count goes back down to support. Now, so potentially more to go on the S&P, but let's go down here and look at the NDX. Now, this is actually a bigger chart time-wise in the regard that we're looking at daily data, and we're going back and we're taking the first count off of the test of the upthrust. Well, this is the upthrust right here where the number 16 is. And so you can see that it had one final push up to a new high, and we take it back 16 columns, and this gives us a count, and this count takes us down to 6,900, 6650. And so we are now in the zone of fulfilling that count. And this is an interesting place because this looks like completed distribution. Now what we want to see is whether or not after going below this sign of weakness low that was made earlier in the month, whether or not there can be an attempt to rally back up. And then we want to see what's the quality of the rally. So we're in the target zone for the point and figure. If there's an attempt to rally today, if the quality of this rally is really good, This will give us great hope for the market as a whole. What we're concerned about is if distribution is complete, then the quality of the rally, which we call a last point of supply rally, that rally will generally be of poor quality. And so there's a number of different ways to identify a rally of poor quality in an emerging downtrend. But the main thing is that the range of the daily bars tends to compress as it goes up. Volume tends to decline. It shows that there's generally a lack of good demand as prices rise. And so alternatively, if we're going to get a good rally that shows that this correction is over, then we should see the opposite. We should start to see good, vibrant, bullish bars and widespread. Ramon?
Well, Bruce, yesterday you presented to us a material on the sentiment indicators, and some of them are suggesting that we might have that, pause in the down move, and we could have some kind of rally. How do we quickly identify that, that short-term rally could come?
This is a sentiment indicator. These are put-call ratios. They're very interesting. These are available on the Decision Point files that are available to StockCharts subscribers. And so here, this put-call data, when the number gets quite high and overbought, that means there's a lot of put buying, which normally coincides with important lows. And you can see here that this decline off the peak has come with a lot of put buying, which has gotten near the extreme overbought levels. Same thing with the equity, that's Savo equity, similar phenomenon. The interesting thing about the OEX, which used to be a very popular, highly traded index of 100 S&P, top 100 S&P stocks, is that it doesn't trade as much anymore like it once did, but you can see that it tends to work kind of opposite to the way that the other put call readings are. And that is it shows that there's a lot of call buying at the lows and put buying at the highs, which is what you would expect to see. And so this is kind of an interesting indicator. And right now, it shows that there was a lot of put buying at the highs, which is timely. And the number is coming way off and could soon be in a place where it shows that there's call buying in the areas of a low development. Ramon?
Mm-hmm. Well, let's look at the intraday picture and just kind of see where we are with this. If we're thinking about a contrarian short-term view, for the rally to come, then do we have this? And what kind of rally do we have within the context of the structure? So this is a 15 minutes NDX data, and we're seeing a very persistent downtrend, a stop in action of the climactic qualities, an automatic rally, and this reaction to the upside is a change of character. It stops the intraday movement down, and you guys could see how on the intraday we have all of these wonderful structures as well that we could identify. An up thrust, and then lower low, lower low, lower low, and look at this latest rally, Bruce. It comes right to the point of where the selling climax has been formed before. What does it mean?
Well, it appears to be an attempt to come under accumulation, and this is very encouraging on a smaller time frame. And so this is hopeful for a good rally to come after the completion of a minor accumulation.
We have two scenarios here. Either continuation to the upside would be seen as a bullish scenario, or just tanking to the downside, and that would be a continuation of the bearish scenario.